Hello and good morning, folks. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Well, it's good to be back on the podcast after quite a long time. And what do we say? August. I'm just trying to soak in the August chill. We got one of the long weekends done with, and right, another one is standing right in front of us. So it has been quite an relaxed period, but I don't think so it's much more of a relaxed period for the Fed. We had the FOMC minutes released yesterday, and things are still on the cards with respect to inflation management and the rate hikes. So JK, what should we be expecting out of those FOMC minutes and the actions for Fed, as well as how are currencies reacting to all these activities?
Hey, good morning, Shikhar. Yes, I think this is a very heavy week in terms of economic data and events. And yesterday we kicked off with Kiwi rate hike of 0.5%, taking the policy rate to 3%, and they are not done with yet. And they will be hiking another 0.5% in at least one more month. So that was the monetary policy actual event. Then we had lead up to some more monetary policies, like UK inflation jumped to 10.1%, the highest since 1982, the first major economy to see double-digit inflation, and food costs actually making a big squeeze on household budgets. The increase in inflation from 9.4% last month was in fact broad-based, with 9 out of the 12 components rising and beating all the forecasts. It's just confirming that UK MPC will raise rate at least by 0.5% in September. But what's worrying is such a surge in inflation is not accompanied by enough growth, thus the overall economy is likely to struggle with tighter financing conditions. It's not therefore surprising that UK pound fell closer to 1.20 again, despite a big surge of 18 basis points in the gilt yields. Investors are now pricing in BOE rates peaking at 3.75% around March 23, up from 3.25 previously. So analysts are expecting inflation in UK to hit 15% before peaking. That's a very staggering inflation number for some investors who have been used to below 3% and all that. Then we had the US retail sales that came unchanged in July as declining gasoline prices weighed on receipts service stations. So actually the lower inflation is masking the steadiness of spending in the consumer sector. Forecasts had ranged between in fact, a very wide range of plus 0.1 to minus 0.3. Expectation is that such the strong wage gains from tight labor market and ample savings should help to underpin the consumer spending in the months ahead, particularly if gasoline prices stay low. So it's to be noted that retail sales in June, which had reportedly risen by 1%, was revised downward to minus 0.8%. But overall, I think with inflation coming down, investors are taking a positive view on consumption from the retail, crowd. It is also something good for Q3 growth numbers. Let's wait and see. That will be announced later in the month. Then all important minutes of Fed meeting of 27 July were released, which is read as cautiously dovish. Dovish interpretation of the minutes were enhanced by recognition of potential for over-tightening. So participants judge that as the stance of monetary policy tightens further, it's likely to become appropriate at some point to slow the pace of it while assessing the effects of cumulative policy adjustments on economic activity and inflation. It also said that although recent declines in gasoline prices would likely help produce lower headline inflation rates in short term, declines in prices of oil and some other commodities could not be relied on as providing basis for a sustained lower inflation, as these prices could quickly rebound. So participants also indicated that once the policy rate had reached a sufficiently restrictive level, it's likely to be appropriate to maintain that level for some time. So supposing the target rate is at 3.75 neutral rate, that probably will be maintained for some more time, and Fed will not hurry into cutting immediately, even if there is some slowdown. That is what this indicates. Majority of the market is now leaning on 0.5% rate hike in September. So the minutes provided bond bulls reason to ramp up buying in the short-term bonds, which showed up in 2-year yield falling by 12 basis points to 3.25. But that's an intraday move, but it had actually started higher. And the long bond yield stayed at the highs. Thus, the steepening of 210 yield curve is slightly up from minus 47 to minus 38. Stocks had a volatile session, but that is to be expected when we had big ticket data like retail sales and Fed minutes and markets trading at 2-month highs. Overall mood appears that investors are taking profits on the recent rise and await more clues on the economy. Major stock indices were down 0.5%, while tech-heavy Nasdaq lost more, like 1.25%. Dollar was generally stronger against most currencies, up 0.2% as far as the DXY is concerned. Although it gave up some gains post the FOMC minutes. Of course, AUD and NZD were underperforming on the day, losing more than 1%, all because of Chinese slowdown. And UK inflation print, it only gave us a short-lived reaction to the upside, but it came down. The UK pound came down substantially. Market has been actually selling currencies where there was or has a prospect of a hefty rate hike, has a perception whether the economies like UK, Australia, and New Zealand can handle the slowing economy amid record inflation, and hence prefer the safety of US assets still. Euro is still trading in a very narrow band of 1.0125 and 1.0180. Still looking for direction and possibly some trigger. On the rupee front, we opened stronger with a gap of almost 40 paisa. And it was not surprising to see some importers jump into hedge near 1730. Amid reported large outflows due to stake sale by some of the foreign entities in Indian companies and persistent oil demand, the pair stayed below 79.50. That itself will be considered as positive. The continued weakness in Chinese yuan as well as heavy tone in other major currencies did not really affect the rupee much. Reports in some media about Indian bonds being included in global bond index next year added to sentiment, even as Brent oil stayed well below the pre-Ukraine war levels. So drop in oil prices augurs well, not only for moderating inflation, but also to improve our trade balance. FII flow, meanwhile, continues to be positive for all of the days in the month of August, with total inflow touching nearly 5 billion USD. That's the fantastic reversal of the flows, because we used to have average 5 billion outflow for almost 9 months since October last. So that depicting renewed foreign interest in Indian equities and even bonds as well. So with a better balance in demand and supply, impact on rupee should be positive. That looks technically poised for some more gains towards 78.90 in the weeks ahead. But I think the rupee is still not giving a very strong signal either side. So we should be content with slow moves, all the moves being contained within 79 and 80 for quite some time. Thank you.
Okay, JK, that was quite good. And like you mentioned, even though it was a data heavy week, I think a lot of Indians are enjoying it like a holiday season with so many holidays coming in. Meanwhile, folks, keep in mind, we'll continue to keep bringing us along with us all the updates that we are going through in the financial markets, with the UK inflation printing above 10%, keeping the expectations of a tighter condition, and the BOE's neutral rates to be around 3.75, which can definitely put pressure on the pound as a currency. But at the same time, for our domestic currency, there is a whole host of factors which are coming back into action, influencing its moves in both the directions. For example, the stake sale, as JK mentioned, stake sales have been one of the reasons for a move on the higher side, along with the macros continuing to be on the stress side, while we have seen some bit of low action with the FIIs, and the declining oil prices can also help the trade balances. So there's a lot of things happening in the FX markets, and there's a lot of possibilities of further things happening. But stay tuned with us. We'll continue to bring all the updates just for you. Thank you for listening. We'll come back again tomorrow.